Hi everyone, I'm Garrett.
I'm Collins.
This is an analysis on EA versus ActivisionBlizzard. First we have the ownership breakdown in stock. Up top is EA and below is Activision. Looking at the charts, EA only has 300 million shares outstanding compared to Activision's 1.1 billion. Although EA has low shares outstanding, it has a higher spread of ownership between institutions compared to Activision. The reason Activision has such a lower institution ownership is because Vivendi holds over 60% of their stock. Based on the ownership structure, EA is the better selection. The reason EA is a better selection is because their stock is evenly spread with no person or company holding to a large percent in stock. With 60% of Activision stock being held by Vivendi, the future of Activision is cloudy. Not knowing when or what Vivendi will do with their share is the reason why EA is preferred. Why do investors care about capital structure? With capital structure, you can see a company's debt, and with debt there's advantages and some disadvantages. Another thing capital structure comes with is the tax rate, and also how the ability to pay off debt. And last is the firm projects and the research and spending. Looking at the third bullet point for firm projects and research spending, EA and Activision are video game companies, so any money that they borrow which creates debt, their spending is going to go towards mainly research and development in software and future technologies for the new consoles like Xbox 720 and PS4. This is where most of their spending will go towards. Here's the capital structure between EA and Activision. As you can see, Activision has a lower debt ratio compared to EA. The base stock is also lower, the cost of equity is lower, but they both have AAA bond ratings. Next is the WACC, which is Activision also has a lower, and the firm value for Activision is greatly higher than EA. ActivisionBlizzard is the best choice for capital structure. The reason is they have a lower debt ratio, a lower WACC, and the firm's value increases with perpetual growth more than EA. The reason Activision has a lower debt ratio is because their net income was greatly higher than EA, and that they had very little to no long-term debt. This is why Activision should be chosen for capital structure.
Alright, EA's cost of debt financing. They came up with an S&P credit rating of AAA, which is 0.65%. The 10-year T-bond as of January 4th of 2010 is 1.87. Pre-tax borrowing cost is 2.52. And according to our sources, the effective tax rate is 0%, which leaves them with an after-tax cost of debt of 2.52%. ATVI's cost of debt financing, they as well had a AAA credit rating at 0.65%. Their 10-year T-bond is the same as EA's at 1.87, which leaves them with a pre-tax borrowing cost of 2.52%. And our sources state that their effective tax rate is 18.48%, which leaves them with an after-tax cost of debt of 2.05%. We chose ActivisionBlizzard for our cost of debt financing because their EBIT of 1.3 billion is greater than EA's of 18 million, which led them to having an effective tax rate, whereas EA had a tax rate of 0. As a result of this, it led to ATVI having a lower after-tax cost of debt, which means that they are bringing in more money than EA.
This is EA's and Activision's cost of equity. Here's a 5-year monthly trend of EA versus the S&P 500 and also Activision versus S&P 500 for a 5-year monthly, which helped calculate beta for Activision at 0.59 and EA at 1.22.
Alright, so what is our cost of equity financing? For ActivisionBlizzard, we use the CAPM, which pretty much solves your cost of equity. The beta, which is from our previous chart, is 0.59, and our intercept of negative 0.2 is from our regression analysis. The 10-year Treasury bond is 1.87, which meant that our cost of equity using CAPM was equal to negative 3.12%. As for EA, beta based on the previous chart, it was 1.22. Intercept using regression is 0.46%, which led our cost of equity, according to CAPM, equaling 5.88%.
Continuing on the cost of equity, we also used the 3-year weekly. For EA, against the market, the beta came out to be 1.03, and for Activision, against the market, was a beta of 0.56.
Alright, now for the cost of equity financing for a 3-year weekly return for Activision, using the CAPM, the beta now is 0.56, and the intercept using regression is 0.21%, which leaves us with a cost of equity of 10.1%. EA, on the other hand, has a beta now of 1.03, and according to regression analysis, the intercept is 0.37, which leaves us with a cost of equity of 19.3%.
Here's the bottom-up approach for EA and Activision. We used the weighted average beta, which is 1.23. The reason we got this was from 40 different companies at weighted averages came out to be 1.23. The reason the revenue is at 100% at Entertainment Tech is because EA and Activision only sells video games. They have no other revenue, so that is why it's 100%. And you times that beta by 1.23 gives you 1.23 for the beta for EA and Activision.
So for cost of equity finance, we chose ActivisionBlizzard because their beta is less volatile to the market. It's lower than EA's, and with the presidential elections coming up, it'd be a safer bet to have a lower beta due to the volatility of the market rising or falling.
Here's the overall cost of capital for Activision and EA. Starting with Activision, the shares outstanding is over 1.1 billion. The average for 2011 was 9 million. The market capitalization is over 13.3 billion. Looking at the equity and debt ratios, the market value of debt is 0. The market of equity is over 3.3 billion, and with a total of 13.3 billion as well. Doing the ratios, the debt ratio is obviously going to be 0 because the market value of debt is 0. The equity ratio is 100%. Obviously, doing the math, 13.3 over 13.3 is going to be 100%. Going down, the cost of debt is 2.05%, and the cost of equity is 5.12. Combining those gives you a WACC of 5.12. For EA, the shares outstanding is over 300 million shares. The average for 2011 is 7 million. The market capitalization is a lot lower, with over 4.5 billion. EA, on the other hand, has debt of 539 million. The market equity at 4.5, giving a total of 5 billion. Doing the ratios, the debt ratio is 10.68, the equity ratio of 89.32. For the cost of debt, gives you a 2.52, and the cost of equity of 8.58, which gives you a 7.93 WACC percent. Activision is the best for overall cost of capital. The reason is WACC is lower than EA. It has no debt, which concluding for a lower WACC, and with low WACC is able to acquire capital more cheaply, so if they want to borrow, can get at a lower rate, in which Activision is considered less risky. Could we lower the cost of capital by changing our capital structure? For EA, they can do this by increasing their net income, which is their EBITDA, which is only at 18 million. If they were to increase that, they could help lower their cost of capital. Also, they have to lower their interest-bearing debt, which is at now 905 million. Because they have such high interest-bearing debt and such low net income, they would have to change these to help lower their cost of capital. For Activision, their net income is very high, and their interest-bearing debt is only minimal. If they were to change that, they could help out their beta stock to help bring them to par and help out lower their cost of capital. Activision is considered the best to help lower their cost of capital if they were to change their capital structure. The reason why they're the best is EA has a higher chance of bankruptcy because they take on too much debt. Activision has a better chance because they don't take as much debt. If they were to, they have better benefits and help lower their cost of capital. Next is their net income is very higher compared to EA. And last, the beta increase could help lower their cost of capital.
So Activision Blizzard is the best for restructuring because it leads to adjusting the assets and liabilities of their company, including their debt to equity ratios and cash flows, to better the efficiency and maximize the value of their shareholders, stakeholders, and creditors. And if Activision were to restructure their company, they can benefit from it. They take on a debt ratio of 30%, which is optimal. Activision would receive a tax benefit of $1.41 billion for taking on their debt, and by doing so, the firm value would increase from $13.4 billion to $13.9 billion. Activision is also the better pick for restructuring because they don't take on any long-term debt. If they were to do so, they would benefit. And they would also have interest on loans, which would be tax deductible due to the increase in debt spending. Would more debt create unnecessary risk? In doing so, it has advantages and disadvantages. The advantages are its tax savings. The interest expense would be tax deductible, while cash flows to equities are not, and this benefit increases with the tax rate. This also leads to added discipline by raising the cost of failure or bankruptcy, and then as it also increases firm value and beta. The disadvantages are that it comes with a higher expected bankruptcy cost due to the probability of default, which is greater for firms that have volatile cash flows. The probability of default increases. There's a lowering of bond ratings and agency costs. The debt exposes the firm to the possibility of conflicts between stock and bondholders over investment, financing, and dividend decisions, and also there's a loss of flexibility, which is more likely to be a problem for firms that have a substantial and unpredictable investment opportunity.
Here we have EA and Activision versus the industry. First, we're going to look at assets. On the left-hand side, we see other current assets at a percent of total assets. We can see that Take-Two is the highest, around 30%. Now looking at the bottom at long-term assets at a percent of total assets, you can see Activision EA for being the highest. Reason behind this is because they've been around longer than Take-Two and Zynga. Next, you look at the size of each bubble. The largest bubble being Zynga is because that's how much cash they have compared to the other companies. And since Zynga is probably the youngest around, that's why they probably want to be more liquid and with higher cash. Here we have the liabilities for EA and Activision versus the industry. Starting on the left, we have the shareholders' equity, which you can see Activision and Zynga being the highest, around 80 to 7% for their total liabilities. Next, you look down below at long-term liabilities, being EA and Take-Two being the highest. This may be due because they take on more debt. Next, you see the size of the bubble, which is their current liabilities, which all seem to be around the same size. Here we have the market capitalization, the debt ratio, and long-term debt over equity for EA and Activision versus the industry. Starting with long-term debt over equity, you can see that EA and Take-Two take up most of this. Next, you see total liabilities over total assets, which is your debt ratio, and this is noticeable to be EA and Activision. Next, you see market capitalization. As you can see, Activision is the biggest one because they take up $13.3 billion for a video game industry, which your next highest was probably Zynga, only about $4.8 billion.
Is our stock price fairly valued? In determining whether it's overvalued or undervalued, we use the formula PE ratio times earnings per share. For Activision Blizzard, we estimated $15.54, and for EA, we estimated $16.95. The closing price as of September 19, 2012 for Activision Blizzard was $11.88, and for EA it was $13.93, and the current prices for both are undervalued.
This concludes our analysis of EA versus Activision Blizzard.